Retirement fund. What exactly is a retirement fund? What is the goal of a retirement plan? This video will provide you with an answer to this question. Watch this video all the way through to get a sense of what the retirement fund is all about. Retirement funds, also known as pension funds, are investment options that enable people to save a portion of their income for retirement. After retirement, these funds provide a consistent source of funding. A retiree receives an annuity on their investment until death. Pension funds invest on behalf of the investor, and the income generated from that investment is contributed as interest on the pool of funds. These provide a fixed benefit because they are not affected by asset returns or market fluctuations. To ensure consistent returns, retirement mutual fund plans typically invest in low-risk investment options such as government securities. Pension funds typically offer up to 11% interest depending on the policy and investments, making them the best alternative for retirement planning. The primary goal of a retirement savings fund is to provide a consistent source of income for an investor who does not have another source of income. It is a type of deferred pay that provides financial security and enough capital to pay for individuals' necessities. Most retirement funds allow you to receive your returns as a monthly annuity or as a lump sum. An annuity is a fixed-rate payment that, in most cases, includes inflation protection. One of the most significant benefits is that an investor receives the return from their retirement fund adjusted to the current denomination. After retirement, lump sum payments distribute the total amount of accumulated wealth to the investor. It provides substantial financial support, but it eliminates the regular source of return from monthly annuity payments. Contributions to retirement mutual funds are tax deductible. Contributions can include both the purchase of a new pension plan and the renewal of any existing fund in order to extend its services. The withdrawals, however, are tax deductible. Because the money is distributed as an annuity, it will be taxed at the current rates. Pension payments are fully taxable, just like policies levied on an individual's salary. However, if an individual chooses to receive the total amount after retirement, the taxation policy may change. Government employees will be exempt from all taxes during disbursement. Non-government employees are only eligible for partial tax exemptions up to a certain amount. If a pension includes a gratuity, 1/3 of the total amount is tax exempt. Otherwise, only half of the total fund is tax exempt. Pension income received as a monthly annuity by any family member is taxed as income from other sources. However, it is tax exempt up to a certain threshold. Individuals who choose to distribute their entire retirement fund are tax-free. We should put money into a retirement fund. Pension plans provide a source of funding for both everyday necessities and unforeseen events. These mutual fund retirement plans are much less risky than other types of investments, making them ideal for citizens seeking guaranteed returns. Furthermore, an investor can select from a variety of pension funds, allowing them to plan based on their specific financial needs. There are various plans from which to choose. The most popular plan invests solely in debt profiles, making it extremely safe and ideal for a cautious borrower. There are also unit-linked plans that invest equally in equity and debt profiles. These have a slightly higher risk, but offer higher returns. Investors can, on the other hand, choose national pension schemes, which are government-backed retirement funds. This scheme allows for investment in both the debt and equity markets, depending on the investor's preferences. Additionally, at the time of retirement, one can withdraw 60% of the total fund and use the remaining 40% as an annuity payment. The amount at maturity is tax-free. What should the investing mode be? There are primarily two ways to invest in these types of funds: make a one-time lump sum investment or invest through a systematic investment plan. Both of the aforementioned processes have advantages and disadvantages. Lump sum investments, for example, promise significantly higher returns with market appreciation. They are, however, more vulnerable to risks than SIPs. It is worth noting that only experienced investors prefer such one-time investments. Systematic investment plans are better suited for first-time investors because they instill the habit of investing and build a pool of funds over time. It enables new investors to capitalize their wealth without incurring any financial risk. It will also assist them in more efficiently planning for their retirement benefits. How will you determine how much you will need for retirement? When calculating a retirement fund, an individual must consider several factors such as their potential retirement age, life expectancy, inflation, rate of return, and so on. Someone in their 30 seconds, for example, will have 30 years to save or invest for retirement. In order to maintain financial stability after retirement, annual expenses should be higher than savings. Online applications, such as the Grower Retirement Calculator, can also be used to quickly determine the required amount. It calculates the amount needed for retirement by taking into account several key factors such as an individual's age, monthly expenses, potential inflation rate, and so on. It also shows how much money should be saved each month to reach the goal. Some major reasons why you should consider and begin retirement planning are listed below. There are numerous advantages to retirement planning, ranging from financial to personal and psychological. Let's take a look at 7 common reasons why retirement planning can help you. 1. Peace of mind. By far one of the most important advantages of retirement planning. Planning ahead of time reduces stress not only during retirement but also in the years preceding it. A lack of planning can create a cloud of uncertainty around the topic, adding unnecessary stress. 2. Contextualize pre-retirement decisions. With proper planning, you will be able to make more efficient career-related and general financial decisions prior to retirement if you take the time to plan for your retirement early on. Is it better to stay with your current law firm or to start your own? Will the mid to late career degree, license, or other credential make financial sense? These decisions may differ for someone with 15 years until retirement versus someone with only 5 years. 3. Getting on the same page. One advantage of early retirement planning is that you can ensure that your plans will work well with other relevant parties. It's never too early to ensure that you and your spouse have similar spending and lifestyle goals in retirement. But your significant other may not be the only family member with whom you should speak. Some retirement plans are frequently influenced by a saver's desire to achieve other goals, such as assisting an adult child in starting or acquiring a business. You will benefit from planning ahead of time if these goals affect your own retirement savings. 4. Tax benefits. Retirement planning has several tax advantages, including lowering the amount of income taxes you will pay during retirement, and ensuring that beneficiaries of retirement and other account types pay as little tax as possible. Tax diversification is an important aspect that many people overlook when saving for retirement. This entails creating various pools of money in accounts that are taxable, tax-free, and tax-deferred. These various accounts enable income to be strategically withdrawn from a variety of sources during retirement, depending on future conditions. Deposits that are both tax-free and taxable. A retiree who only has a tax-deferred account may pay significantly more in taxes for the same withdrawal amount as another saver who has a traditional IRA, Roth IRA, and regular taxable funds. The sooner you start planning, the easier it will be to establish and grow your funds among these available pools of money. 5. Cost saving. With proper planning, there are numerous ways to cut costs. Many insurance policies can be obtained at a lower premium when you are younger and in good health rather than waiting until retirement and risking a higher rate or denial of coverage. Those who know where they want to live geographically often want to look into options other than buying when they retire. Is it financially prudent to purchase the property in the desired retirement location in advance and rent it out until retirement? How much time do you need to plan ahead of time if you want to build a new home? Early retirement planning can increase the likelihood that your objectives will be met at the lowest possible cost. 6. Viewing financial issues in context. One of the most significant advantages of planning in general is that you can determine how all of your financial goals relate to one another rather than evaluating them separately. What are the tax ramifications of my investment decision? How will my decision to purchase additional insurance affect my savings contribution? What impact do these issues have on my heirs? Consider your financial decisions not as a series of yes/no choices unrelated to one another, but as a collection of competing interests, each of which is influenced by the others. 7. Legacy opportunities. Retirement planning can also benefit your heirs or your favorite charitable causes. Consider your legacy in its entirety, not just the distribution of your assets to various beneficiaries at death. Your desires may be more complicated than you realize. Like and subscribe to this channel now for more seasoned videos like this.